In the United States, millions sign loans thinking it's just them and the bank. A personal contract, full responsibility. But hidden players shift the burden. Banks lend boldly. Federal agencies back them up. Taxpayers foot the bill. Who really carries the risk? Not the borrower facing collections, not the bank walking away clean. It's you, the American taxpayer, through agencies like the Department of Education, USDA, SBA, FHA, and VA. This system guarantees trillions, protecting lenders while borrowers pay the price. Who benefits? Institutions thrive. Everyday Americans rarely do. The U.S. loan guarantee system names its true players. What happens when you take a student loan for college, a farm loan for crops, a small business loan for dreams, or a home mortgage backed by FHA or VA? These aren't simple debts. They are federally guaranteed across America, from rural farmlands to urban housing markets. What it means, private banks issue the loans. If you default, the government reimburses up to 95%. SBA for businesses, USDA for farms, education for students. Where does this play out? Everywhere, loans fuel the economy. $1.6 trillion in student debt, $44.8 billion in recent SBA small business guarantees, billions more in farm and housing programs. Outstanding guarantees top $3 trillion nationwide, turning risky bets into safe bets for lenders. What looks like your burden becomes a national safety net. For banks, when did this start? With the 1944 GI Bill's VA guarantees for veterans' homes. 1965 brought student loans via the Higher Education Act. Farm programs grew through USDA in the decades after. SBA launched in 1953, expanding small business protections. By 2024 to 2025, guarantees hit record highs. $44.8 billion in SBA loans alone, with trillions outstanding. Why does it exist? To boost credit access in key areas. Education builds workers. Farms feed the nation. Businesses drive jobs. Housing stabilizes families. Lenders hesitate on high-risk borrowers. Guarantees lower their skin in the game, spurring lending where markets fail. But why the imbalance? Banks earn steady interest. Defaults trigger payouts from public funds. The system prioritizes flow over caution. How does it work? Step by step. You apply through a bank. They check basics, but with a guarantee, scrutiny softens. Up to 90% coverage on rural homes, 85% on SBA loans. Bank approves, issues funds. You repay or face penalties, wage garnishment, ruined credit. Default? Bank claims from the agency. Government pays the guaranteed share, often 75 to 95%, from taxpayer dollars. How banks change. Risk vanishes, so they lend more. Bundle loans, sell them off. Volumes soar, standards slip. Loans become tradable assets, backed by Uncle Sam. Defaults don't crater banks. They activate the shield. How the risk flows. From your signature to public coffers. How does it compound? New programs layer on. SSBCI for states. TARP echoes in crises, pushing trillions in exposure. Banks chase guaranteed sectors. Abundant credit for farms, students, startups. Scarce elsewhere. You bear collections. Banks collect fees. Government socializes losses. $24.5 billion subsidy shift in recent years. This Kipling framework reveals it. Who? Taxpayers lose. What? Guaranteed trillions. Where? Nationwide. When? 80+ years building. Why? Access via protection. How? Claims redirect costs. The system hums silently, powering growth while hiding true costs. Millions borrow unaware. Question it. Understand it. The U.S. loan guarantee endures. Designed, not accidental.